So there's three taxes that are most common in an estate administration situation. So when somebody's passed away. So the first tax that would still apply on somebody's passing would be their final personal tax return. So no different than you do every year with your tax returns. You have to file a stub tax return from the beginning of that year, January 1st, to the date of death for the person's final income tax return. In regards to that return, there would also be a trust return that the accountants would typically file for the estate, just returning completion and certificate of compliance from the government, from CRA for releases. There is also a probate tax that potentially could be applicable, and this probate tax is an administrative tax that the government levies on certain assets to one's estate. So for example, if you owned a house when you passed away and it was in your name by yourself, there's no surviving owner, no spouse, etc., passed away, you own the house just by yourself, the value of that house 9 times out of 10 is going to be subject to probate tax, which is a 1.5% tax on all assets subject to probate. The final tax that could be applicable when somebody passes away is capital gains tax. So take that same example, you own a house, a primary residence, but then let's say you own an investment property as well. You're the sole owner on both properties. We've already established that probate taxes would apply. With the investment property, probate tax would be applicable to that value as well, but you'd also have capital gains taxes. Because it's not your primary residence, you can't claim a primary residency exemption, and therefore you have to pay capital gains tax on the gain accrued since you took ownership of the property and when you passed away. And that tax is 50%. So you have to pay a 50% tax on the gain of the property at your income tax bracket at the date of your death. Thank you.